So it's my absolute pleasure this morning to welcome you to our seminar on megaforces. What we're going to focus on this morning is having a look at what are some of the really big megaforces that we're seeing globally that are going to impact on business in the next 20 years. And the reason that we're keen to have a seminar on this is we think that if you know about what they are, you can manage for the risks and opportunities within your business. And over the last year, we've done a review of all of our members' sustainability reports. And one of the things that came through when we've been talking with our members about the results of that is a number of companies have said it would be really good to have more on what are some of those really big strategic issues that are going to hit in the future so that we can start planning for them. So we're incredibly lucky this morning. We've got two people who really know their stuff who are going to present to us. So what I'm going to do in a minute is introduce you to both of our speakers, and then what we'll do is have each of them present. There'll be an opportunity for some questions after each presentation, and then at the end of the session we're keen to have some discussion on what you've heard. We're filming what we're hearing this morning so that those members who can't attend in Wellington and Auckland will be able to get the benefit of what we're hearing today. So I'd like to start by introducing you to Chi Wu. He's a partner from KPMG's Australia's Climate Change and Sustainability Practice. He's got 15 years of experience of advising business on sustainability issues, and for those of you who have grappled with the GHG protocol, you might like to know that he's one of the lead authors who worked on that with the World Business Council for Sustainable Development and the World Resources Institute. So over the last couple of years, KPMG's done a lot of work in this space. So what Chi's going to walk us through is what they're seeing as some of the key megaforces that they think are relevant for business over the next 20 years. But he's also going to give us an introduction to a very recent report that KPMG has just done, which really makes the case for business needing to look more at how they internalise externalities. And I'm just back from the World Business Council meeting in Atlanta, and let me tell you, that is a hot topic. So it really was a focus of global business leaders. A number of them were talking about how they're starting to do it, and a lot of the banks who were there were looking at how they can enable business to go further with that. So I'm really looking forward to hear what Chi's got to say this morning.
Thank you. Thank you very much, Penny, and thank you, SBC, for the opportunity to come and talk to you about this. I do have a clicker, thank you very much. So there's a really broad range of areas and issues that I thought would be interesting to have a discussion with you on today, and we absolutely won't have time for all of it. So what Victoria and I would love to do is to make sure that if you've got any questions or areas of focus or particular interest areas, absolutely flag them as soon as you like, and we'll try and weave that into our discussion. But based on what Penny said, what I want to touch on a little bit, well, let's just say there are three areas. One, what we are seeing in terms of trends on megaforces, but also general sustainability. Not so much about what are the big trends taking place, but how we're seeing organizations grapple with them and take them into account and deal with them internally. How do you digest megaforces in a way that is strategic, not just tactical? And that is a space that we've been working with the Global Reporting Initiative on for quite a while on this report that will be launched, and Victoria will talk about that too. Right. Great. You're not going to see this, hopefully. Do you know what this is? Piece of wall art, perhaps? It's the picture of the financial system in the US on the day after the collapse of Lehman Brothers. The red lines are the lines that represent interbank failures on transactions. Transactions were defaulted or delayed significantly. And the blue lines represent transactions that pass. So the thicker the lines, the more transactions, right? The day before the collapse, that would have been a completely blue picture. Why is that relevant to sustainability? The financial system learned after the collapse of Lehman Brothers in 2008 and in the years that followed, the importance of understanding and mapping the interdependencies between organizations. They recognize, and this is reserve banks, as well as the biggest banks in the world, recognize that you can't just look at your resilience in-house. You have to understand how you interact and are dependent on others. And the same applies to sustainability. You can play it out in climate change, which is this story here. You can't look today, interestingly, at the sustainability or the resilience of a city just by considering the infrastructure of the city, which assets are above sea level and projected to be completely safe under 100-year storm surge events. You've got to look at how the city as a whole functions and how it depends on goods and services and inputs coming from halfway around the world, perhaps. And maybe the issue is about what the sustainability or climate change challenges are in Thailand, not just in the greater Sydney area, as in this example here. So interdependence is a major issue that is creeping into organizations' risk management processes. So when you come to look at the traditional way of looking at materiality, for example, in sustainability, severity and likelihood on two axes, this is the future that we think the picture is going to look like in sustainability reports. Another story, this is a part of the project that's taking place with the Australia Business for Biodiversity Initiative, ABBI, and it's being done in conjunction with another project called the Natural Capital Protocol project, being funded through the UN. And here, the discussion is going around, and Penny and I talked about this briefly just now. The world of natural capital has traditionally been about how are you impacting on the ecosystems and natural capital, and what are you doing to mitigate and reduce your impacts. And we know from our industry that we've had very limited traction in that space. So what is this trying to say is to turn the argument on its head. The question now is not how are you impacting on natural capital, but how are you dependent on natural capital? And if you are, so this is the primary industry section, and so there's a lot of understanding of impacts here. When it flows through into manufacturing and services sector, all the way through to final consumption and investment, financial sector, there is complete lack of understanding. There is no clear mapping of the financial sector's dependence, for example, or the tourism sector's dependence on natural capital. And so if you move that story on that I just talked about on interdependency, how, as an organization like a bank, do you know your weak spots? Where are the areas that could lead to impairment of assets or impairment of investments? And what's your process for understanding that and then engaging with the right stakeholders to manage that process? Megaforces, what I'm here to talk about. Can I just get a show of hands? Am I right in saying that most of you here have a good appreciation of megaforces in terms of the general themes like energy security, food security, water security, climate change? Okay, good. Because what I want to focus on is this big question that I just get totally frustrated on all the time. So on the left, you have the World Economic Forum's, it's actually 2014. This one's not done yet, right? I'm not that up to date. World Economic Forum's Global Risk Report for 2014. And over the years, if you overlay the global risk reports year after year, I think I should be standing in the middle, shouldn't I? Year after year, you'll see that there's a creeping in of sustainability issues in the global risk reports to such an extent that if you look at the most recent one, at least half of them have strong relationships to sustainability issues, which is not a surprise, is it? That's sustainability by definition will impact on mega risks that these, remember global risk reports actually a survey-based report from big business around the world. But the big question I have is why aren't these same issues explained, articulated, connected to strategy and risk in these same organizations that identified these sustainability issues? Why is that? Is it because they're not understood or they're not in the consciousness of management? That's not true, because a lot of it's in the media, everyone talks about it. Is it because it's hard to connect? And if so, what can we do to help that process? So that was the basis of our second report. The first report being Expect the Unexpected. So here are the mega forces. This is the trend. This is based on a lot of reports, 22 surveys and research papers, and it's the aggregation of all of those that talk about how these issues are accelerating moving forward in the next 20 years. The next report is about, well, how are these issues, how can we use these issues as a lens to view the future world in which we can create some logical basis for analyzing which externalities, upstream, in-house and downstream, we should be happy about because they're positive externalities to do with how we're differentiating our products and our services. For example, we're using more energy efficient products or sources, or we use renewable energy, or we have an incrementally better way or approach to managing our people from a human rights perspective around the world. How are those positive externalities going to be internalized? And internalized means how are they going to work their way through into profit and loss and assets and liabilities? How are the mega forces going to lead to those? Which mega forces are going to create the internalization process? And from a negative perspective as well, that translates into risk, and the risk to future profits. What is the risk to future profits? So this is an analysis that was done in the first paper, Expect the Unexpected, and it looked at the total potential risks at stake in relation to internalization of environmental externalities. And this was done with true cost. If you look at the total picture, it's the expectation or the forecast is that if all environmental externalities were to be internalized, and we know that's not going to be the case yet, then we're talking about almost half of all earnings being eroded. And if you look at the food and beverage sector particularly, food producers down here, the externalities outweigh the actual revenues today, almost 2 to 1, which is horrendous, isn't it? And of course, that's not going to be the case in reality. The reality is that some of that will have to be absorbed and internalized, and some of it will have to be passed through to the consumer, who will have to bear the end cost. So I urge you to look at that report because it does provide a framework for thinking through the scenarios that could lead to internalization of externalities. And we analyzed it from we identified 3 drivers for that. Regulations clearly will lead to internalization of risk and costs. Stakeholder action, and we're increasingly seeing that with the help of social media pressure and technology, where we will expect, or we can expect to see the bottom right triangle on stakeholder action being almost eclipsing all the other pressures from regulations or market forces perspective. And then, of course, market dynamics. This is supply and demand. Yeah. Now, what are the mega forces that could lead to a disruption of supply or an increase in demand? So that's another lens that we talk about. But it's very simple as a framework. What are your externalities? Which are the ones that are biggest? Under what scenarios, based on your analysis of mega trends and mega forces, do you expect which externality to become internalized? And which ones do you want to be internalized, and how do you promote that? How do you agitate for that change to take place? And which ones are bad, and therefore how should you be responding to that? And so our proposition is that that should be the basis of strategy. That strategy, sustainability strategy or business strategy, should be connected in some way to telling the story of how you're protecting the organization from an externalities perspective, positive or negative. This is how it plays out. And this is a case study in South Africa, a gold mine in South Africa. And you can see that when you move from today's revenue and cost base, which is the earnings, so if you start from today's earnings, if done properly, we should be able to have a sensible conversation on how sustainability issues and externalities lead to positives and negatives on revenue pressures that create a true picture of what revenue could look like if meaningful internalization or sense of, not meaningful, but realistic scenarios on internalization are played out. And this is another example of how those things, those issues on internalization actually lead to, in this case, a complete erosion of earnings for this mine in South Africa. Quite an interesting way to engage general business on the importance or the relevance of sustainability through the financial lens. I won't talk about that. That's basically what I wanted to touch on. There's a lot there in terms of ideas and thinking, and I think it would be really useful to spend some time doing Q&A perhaps, or
Okay, so
yeah.
what I'm keen to see is whether there's any burning questions now in terms of what Che's just talked about. Otherwise, we'll move on to Victoria's presentation in terms of how some Australian businesses have used some of this and the value that they're seeing coming through, and then have a bit more of a discussion at the end. So has anyone got anything they'd like to ask now? Mike?
So the question I have is, taking your hypothetical South African gold mine, how does the conversation go with the gold mine when you're saying not only your earnings down, but your EBITDA has been flattened? What's the hook to get them into this?
And that's a very good question. There are two hooks. One is that in some companies, and this is the story of the positives associated with that methodology, is that a lot of there are leaders and laggards in the mining industry. And if you can articulate the investments, say in communities, that you as a mining company are engaged in, and talk about it from a perspective of not just how many millions we're throwing in, but what the benefits are to the communities, but then move beyond that to say, well, how do I translate under the megaforces scenario those benefits to future corporate benefit in terms of differentiation or insulation from regulations? Then am I starting to explain to my shareholders and my stakeholders the rationale for why I'm putting in 1% of earnings into the community now? It's actually about protecting future earnings. And that's the change in the language that I think is potentially quite powerful and useful. The other lever is this, which is if we can understand where the biggest, scariest factors are that could impact on earnings erosion tomorrow, in this case, energy pricing and wage costs and inflation, what can I do as a sector in my economy or as an individual organization to take that out of the equation somehow, or to strategically think about how to move away from that dependency or that damage, so I can move that into, again, positive differentiation territory. And if I can connect my sustainability priorities to those two big buckets there, then again, I'm starting to sell internally first and then externally to my key stakeholders the value of sustainability investment. So in the case of wage cost, you won't be able to read it, but that is based on, South Africa had recently came out of a very long period of industrial strife, particularly in the platinum mines, and it was a 6 to 8 months disruption process, and it was all to do with wages. So the question is, how do we, with the benefit of hindsight first, how could we have come up with an environment that could have avoided that kind of disruption, because we know it costs billions to the industry? And then moving forward, what's the projection based on megaforces on that kind of disruption playing out in the future? Are we likely to see increased agitation in terms of workers' pressure, societal pressure on workers' rights and fair pay, or are we going to see less? And the projection is, of course, that we're going to see a lot more of that.
I was very interested in the megaforce around poverty, or I don't think that's what you called it. Inequality. Mm-hmm. How are you seeing that businesses are responding? I'm thinking of Piketty and Capital, the whole push around actually structurally our system is not going to stand the level of inequality that we have. How are you seeing the internalization of that?
So that one. Two things there. How do we see inequality, income inequality, for example, living standards inequality, are issues that have been identified in a lot of Megatrends papers. Why? Because of the connection to stability, societal stability, but also in terms of missed opportunities. If you have more people with adequate income, you're going to have more consumers, theoretically, right? So how does it play out? Is in this space, if you have two worlds, one that is more equal than the other, which is the one that's going to lead to greater prosperity for the organization, for the company at stake? And how can that individual company develop solutions or advocate or work with others to enhance or reduce inequality? And there's some organizations are doing that already. Some organizations are, look at their CSR or sustainability programs, part of that to deal with the vulnerable in communities, to do with the people that are on the lower income scale. Let's look at some of the banks like Westpac and CBA and NAB, all these banks in Australia. A large focus is on financial inclusion, microfinance. Why are they doing that? Part of that is for reputational reasons. Another part is that they want to bring access to their goods and services to a sector of the economy that doesn't have that information, doesn't have that access to that.
I've got a question. So at the moment, a lot of the methodologies around how you internalise externalities are quite new, and people are just starting to trial them. If you're a business that's not at the stage where you're ready to do that, what would you recommend are some other things that you can do to be building, being aware of some of these mega forces into your strategy?
What I haven't talked about is how this was created. This is a web of interdependency, and it wasn't done in-house. In this case, a city council. It was done through engagement. And there's a concept that is being played out not just in cities for climate change, but also in big financial institutions like reserve banks, central banks, and listed mining companies. And it's the concept of, have you heard of collective intelligence? The wisdom of crowds. And it's through engagement, which is beautifully connected to the whole principle of sustainability and GRI, that if you engage with the right stakeholders who are experts in their own field, and you do it in the right way, could you potentially come up with a better understanding of not just the future scenarios that could hit your organization, but your dependency in the entire value chain that your organization is connected to. And I think a lot of banks, airlines, mining companies are starting to accept that actually that is a very compelling proposition, that no more in the future will we be thinking about stakeholder engagement as something that is an imposition that we believe we have to do because it's the right thing to do, but because it's going to increase our resilience as an organization, that by tapping into the minds of a diverse group of individuals, we humbly can actually learn a lot more about what we should be focused on strategically moving forward.
Great, thank you. Okay, I'd now like to introduce you to Victoria Whitaker. Victoria is the head of the Australian Global Reporting Initiative, and she's very focused on improving the quality of reporting in Australia. And one of the things that Victoria's been focused on in the last year is working with KPMG to really pull together the story of how Australian businesses are getting value from sustainability. And that's incredibly relevant to us at the moment, because one of the things that the Sustainable Business Council members have said that they want to do in the next year is to really tell that story in New Zealand. So we're looking forward to hearing what you've done in Australia, Victoria.
Thank you. Thank you all for having me here today, and thank you, Penny, for the introduction. We, together with CPA Australia, the accounting body, and KPMG Australia, have done this research over the last year. What we've looked at is we've wanted to understand how Australian companies, and we've focused on the ASX top 50 companies, are dealing with sustainability risk and how they're dealing with how sustainability is contributing to value. And what we've done is we've looked at their annual reports, their annual reviews, their sustainability reports, and their integrated reports as key communications to the market that should be communicating this sort of information to help the market understand why they're doing the sorts of things that they're doing. What we've done first of all is we've looked at how they've identified with these 10 megaforces that Chi spoke about. And we selected this particular research of KPMG's because it looked at 22 documents internationally. It looked at all different types of megaforce or megatrend documents, and it drew out what were the most relevant for business over the next 20 years. And in it, it said that these 10 issues will affect every business worldwide in some way, shape or form over the next 10 years, which is why we selected that. So we looked at how have these come out and come through in these major documents to market. And what we found is that on average, it looked quite good. For most companies, they identified with about 8 out of 10 of the issues, which seems quite a lot. But once we dug a little bit deeper, we found that it wasn't as rosy as what it seems. So you can see here population growth by far and away the one that resonated the most, because population growth includes your labour practices, and companies are required to report on their labour practices. Climate change and energy fuel came closely after that. Right up to food security, which had about 17 companies disclose on food security as being an issue to them. We then looked at what were the value drivers that sat around this. So one of the things that investors want to know when companies communicate to market about their sustainability performance is why are they doing it? Why is this relevant to your business? And why are you spending my good money on these sustainability issues. So we looked at these six areas, so securing investment, productivity, risk profile, attracting customers, brand value and reputation, and license to operate, as 6 value drivers that companies should be attributing at least one of them, but hopefully multiple. Hopefully they're building up this great defensive wall that can't be knocked over, because there are so many reasons why they're doing these things that they're doing. And what we found is that while companies are resonating with the issues, they tend not to explain why. So you can see the green line here is their justification of why they're doing something. And it was quite surprising, really, to show that just so many companies are not describing why they're doing these activities. So for example, within deforestation, many companies resonated with investing in forest stewardship or having a policy of using recycled paper or whatever it might be, but they don't explain why they're doing that. They don't explain why that's important to them as a business. What was very interesting also to look at is what was used where, which value drivers resonated with different areas of the business. Productivity, including human capital, so that's productivity around creating efficiencies, but also productivity in terms of getting your workforce better, was by far and away the most significantly used value driver. That, however, was only because it was so widely used within the population growth, which is all about labour practices. After that, it was brand value and reputation that was most widely used, and that was used pretty consistently across all megaforces. What's interesting about that is that's pretty much what we see come out through all the international surveys. Why are you doing this? Well, it's important to our brand value and reputation. What was more interesting around this was that securing investment was utilised so little. In the most times that it was utilised was in energy and fuel, and that was by just 4 companies out of 50. Now, this is particularly interesting because most companies, if you ask them why you're producing sustainability reports, they say, well, the investors are asking for it. So why is that they're not securing them investment, or at least they're not using it as a reason to secure investment? So we were really surprised to see that that wasn't utilised more as a reason for engaging in this. I'm going to go into a little bit of detail around each of the megaforces now. What we did is we recognised that not every megaforce is going to be relevant to every business in the same way. Food security is not going to be as relevant to a bank as it is to a supermarket. That's just, a bank might not be the best example, but maybe a mining company is a supermarket. Still not a great example, but anyway. So what we did is we took GRI's, a publication that we released back in last year, in which we looked at 50 sectors globally, and we said, what are the material issues to those sectors? And so we wanted to include that in this report so as to say, look, we don't expect you, media company, to be necessarily reporting on every megaforce. So that is the dotted line that you'll see around here. The way to look at this is 0 to 100% of companies. Now, there's a different number of companies in each sector, so bear that in mind when you're looking at this. In this one, wealth. Wealth is focused, as a megaforce, it's focused on the growing middle class globally, and what that means for sustainability. So the need for more jobs, increased meat consumption, increased dairy consumption, those sorts of issues coming through here. What we found with wealth is that most companies, when they disclose on wealth, they're really talking about their philanthropy, and that's about it, really. Some of them have looked into human rights, not an awful lot. Some of them have looked at the growing inequality gap within Australia, and then some have looked at the growing inequality gap internationally as well. But by far and away, it was really a focus, when they did discuss wealth, it was really a focus around what they were doing in terms of philanthropy, and quite limited there. So what you can see here is why each sector is focused on wealth. And you can see here that a big focus is on attracting customers, which you might expect if they're seeing a growing growing middle class, they want part of that action. So they're really focused there. When we looked at climate change, one of the interesting things here, climate change is relevant to all sectors. It's a material issue for all sectors. Very focused on mitigation, not so much on adaptation. So every company talked about climate change from a mitigation perspective, and only just over half talked about it from an adaptation perspective. And this is even in spite of 19 companies talking about the effects of weather on their business. So they may have been talking about the effects of weather without thinking about what adaptation things they need to take into consideration, despite their operations being interrupted already by weather activities. With regards to climate change, very much a focus on risk, which is the dark red line within this table here. Some for licensed to operate. Just to mention also that the length of these lines doesn't mean that that sector is doing particularly well. Often it means that there's just more companies in that sector. But the different colours within it look within the sector when you're looking at it. Because for some sectors like forest and paper products, there's only one company in it, so they've identified with 3. Within material resource scarcity, once again, we're seeing different levels of focus by different sectors. We're seeing some sectors like consumer services, they're doing it and yet it's not material to them. So they're going kind of above and beyond, or they've found a way of that it is material to that particular company. Again here, we can see, first of all, in the last graph, this went up to 20 and here it's only at 7. So you can see just how little companies are actually disclosing why they're actually engaged with this particular issue. Attracting customers was one of the bigger reasons, but here important to show there is no one on securing investment. Not one company identified securing investment as a reason for engaging with this particular issue. What we did then is we looked at, okay, well, what does this mean if we were to plot these? Do we see that companies are focused on a fewer number of issues of mega forces, but really driving the value through every angle that they possibly can? Or are we seeing that those companies that tended to focus on more mega forces also tended to have more value drivers and were really able to articulate what value they were getting out of sustainability? Now, if a company was to argue that they are focused on fewer issues, but they really drive the value from it, we would expect to see them here in this quadrant. And they're just not, they're not there. What we found is that those companies that focused on fewer mega forces also had fewer value drivers, really weren't articulating why they were doing things. Those companies that focused on more mega forces tended also to have more value drivers around why they were doing the certain things. What was interesting about this is we then broke it down. This is focused by sector, but we also broke it down by ASX 50 and where they ranked on the ASX 50. We found that the ASX 1 to 20 pretty much sat here. 40 and 50 were down here, and 20 to 30, for some reason, were up here. I don't know why, but they just were. That tend to be where they sat. But here we can see, as we probably expect to see, the mining sectors tend to fall up here. Banks tend to fall across here. Media down here. So a bit of a spread, and some sectors coming out as stronger than others, and there tend to be the higher impact sectors also. Sorry, I'll just stick with this for a second. In terms of what we found overall was that companies tended to be very tactical about how they were going about doing things. What they were focusing on was how they were impacting upon an issue. They weren't focused on how the issue was impacting upon them, which is what Chi was talking about earlier. They were very focused on efficiency activities. They weren't focused on what the risks were and why these were issues that were going to impact upon their business. They really didn't discuss the context within which they operate, which goes back to Chi's very first slide and thinking about all those interdependencies. So there is some work to be done around companies thinking about sustainability through a risk lens and really understanding how these issues are going to be impacting upon them rather than just what they can do to mitigate their activities. So for example, with water scarcity as a megaforce, they were very focused on water efficiency. Within urbanisation, they were focused on waste management. Within population growth, they were focused on, I've lost it. I can't remember that one. Anyway, but they were all very kind of efficiency oriented type of findings. So an opportunity there. We weren't able to investigate, because it would have been maybe it's the next stage of the research, why these companies were this way. But what we wanted to do was look at, for those companies that tend to sit up here, are there common factors that allow them to sit up there and focus in that way? And we found that there were 4. We went and interviewed 7 companies, so not a lot, but we found there was 4 things that tended to come through as enabling factors. First of all, their focus on corporate governance and how they positioned sustainability within the organisation. These companies had sustainability reporting right up to the board. Often the board had a sustainability committee. If it didn't fall at that level, it was perhaps a sustainability committee that was including external stakeholders. There was remuneration tied to sustainability right up to the top, right up to the executive level. The stakeholder engagement was very sophisticated. It was something that held promises right from the beginning, right to the end, right through the suite. It wasn't an activity that was undertaken just for the purposes of determining their material issues within a report. They really sought to understand what those stakeholders were thinking. They made promises to those stakeholders about how they would keep them involved and keep them engaged throughout the process of sustainability. They were transparent and accountable. All of them were reporting, and most of them to multiple different types of frameworks or international commitments. So they were reporting to GRI, they were probably signed up to the UN Global Compact or something along those lines. They held those international frameworks as important parts of their accountability and transparency. And then finally, they tended to, not always, but tended to have this long-term view. These were significant investments that they were making to ensure the long-term success of their business. Stakeholder engagement isn't something you do overnight. It's not a short-term activity with a short-term payback. It's a long-term activity. And so they tended to have these longer-term views. They tended to set longer-term targets and those sorts of things. This has come up quite quickly. I might have to throw in another slide in between there for tomorrow when we're in Auckland. But I just wanted to take you through to the next steps. This is a report that we're launching on the 1st of December. So you'll be able to download it off our website at that point in time, and we'll make sure to send it through to Penny so it can go out in their newsletter so that you can actually download it. I've given you a very quick snapshot of it today. There's a lot more behind it. Our guidelines, they're free to use and you can download them off our website. There's also a disclosure database where you can sift through the 20,000 reports plus that have now been collected worldwide on sustainability. You can sort them all different ways to find your sector or what year you want to look at or which countries you want to look at. You can attend our certified training programs if you're interested in reporting to GRI. EnviroState is our certified training partner in New Zealand, and I think they've got a training program coming up in December. You can become a member of GRI. We call them organisational stakeholders. We cannot do this without the support of our members. The sorts of guidelines that we develop take an incredible amount of time, money, global participation to get up and running. You can nominate for GRI Stakeholder Council, that's like our parliament, and that allows you to influence the development of the guidelines and help us take those next steps around what needs to happen. And you can participate in the continuous improvement of G4. We are moving towards becoming a formalised standard setter. That doesn't mean significant changes to the guidelines. What it means is a change in our governance structures so that governments can hold up our guidelines and say, yes, this is developed within the public interest. And therefore, if they choose to point to a set of guidelines, they can point to GRI's guidelines as something that they would like and encourage businesses to adopt so you can be involved in those processes. So thank you for your time. Sorry, don't need that.
Okay, any questions for Victoria on what she's just presented?
Yeah, I have a question. I mean, great to see a slide of next steps. I'm interested in the next steps to get action out in the wider economy. So do you have a slide that says, we think the way to roll this out to get traction is A, B, C, and D?
Yeah, absolutely. A lot of what GRI does is creating that enabling environment to allow sustainability reports to be valued and utilised. So we have a team that works with governments and stock exchanges and others internationally, and actually 2 of my meetings today are with the government and the stock exchange to see how we can encourage and enable this sort of uptake. We work with the investor community to help them understand what the value and utility around sustainability reports are. We work with the civil society community to help them understand not only how to value reports, but how to influence what's included within reports, and thereby, what a company does around sustainability. So I think that's a really good question to ask of this group, and to ask of the Sustainable Business Council, to really think about how do we ensure the utility of what is produced within sustainability reports, because the fact is they're probably not valued to the extent of what they could be, and it's a collaborative effort to make sure that they are.
So how's the Australian Stock Exchange responding to the report that you've done?
Well, it's not released yet, so they haven't seen it yet. But how they're responding in Australia is this past March, May, the ASX released new corporate governance guidelines and principles. And within those guidelines, there's a principle for risk, Principle 7 for risk. And this year's iteration, they've pulled that out and they've created a new recommendation, which is that companies should disclose their environmental, social and economic risks to the market. Now that's a pretty, I think it's a big step for companies that are well established in their reporting. It's nothing different for them. They've already been doing it, so that's fine. But what it is doing is it's creating a conversation around what is sustainability risk, why is it different from other types of risk, and why hasn't it been recognised in the past. So there are many companies that are sort of looking now to try to understand what this means for them as a business, and what do they need to start focusing on sustainability risk going forward. Now within that recommendation, they recommend GRI, they recommend the UN Global Compact, the OECD multinational enterprise guidelines, and the integrated reporting frameworks. There's different types of guidance that companies could use to assist them in understanding and disclosing on those areas.
I thought it's quite interesting that in that same principle, they talk about not just social, environmental, economic risk, but they also refer to the same language used by the integrated reporting framework, which is that impact, risks that impact an organization's ability to create value or to protect value, and this will keep it in the short, medium and long term. And I think a lot of organizations would easily grab, if they have a sustainability report, hey, we've done it, here it is. But how many of them would be able to say, and we've analyzed the long-term risks, and we've defended the answer to our boards, and they're happy with it? I mean, that process, I think, is still work in progress for a lot of companies.
And what is interesting is that in order to justify what their risks are, they have to kind of exclude other risks as well. So one of our findings for climate change in particular was that for the banks, there's 11 banks, only 3 of them identified climate change as a risk, and one actually specifically excluded climate change as a risk also, which we thought was quite interesting. But of course, they'd have to be able to publicly state that, they need to be able to back it up. Another thing that the ASX did is they changed their language around financial reporting. It's now corporate reporting. So it can include any part of the reporting suite that one would reasonably expect an investor to utilise as part of their decision-making process. So that was quite a shift as well. And then also in Principle 1, they talk about ethics. And they shifted their language around that as well, where they talked about the responsibility not only being to the shareholder, but to the broader community as well. And they went into detail around the impacts of business being on human rights, on the environment, the importance of partnering with businesses who hold up the same ethical standards as you do, and those sorts of things as well. So there was a few areas, in fact, in which they sort of shifted their language a little bit to think about these types of issues.
Thank you. I was just wondering if you thought you might get a different result from non-listed companies, actually, because if you're a listed company, you're obviously focused on your share price, and you're probably a bit incentivized to talk about efficiency and not risk. If you have a whole lot of risks listed there, that maybe doesn't go down well in terms of confidence for investors. And the other issue, I think, with sometimes listed companies, sometimes the CEO, the average sort of length of tenure is only, relatively short, and they're quite incentivized to keep the share price quite high. And I just wonder if some of those mid-sized companies, you know, that aren't necessarily listed, that tend to have a longer investment horizon, they're there for the long term, whether you'd find that the incentives and the attitudes would be different.
Yeah, it's a really good question. I think what we've found is that for the companies reporting in Australia that are not listed tend to be, and maybe this is an overgeneralisation, tend to be subsidiaries of multinationals. So the drivers for reporting are slightly different. One of the significant drivers for those companies is that it's their only communication to market because they don't have an annual financial report. So it becomes a document in which they're communicating to their customers and to their employees in particular. A lot of them are very employee focused. So it's a more of a storytelling document than it is of hard data. And you'll see pictures in it and things like that, which you might not see like within those listed company reports. But we are starting to see a lot more pressure from multinational enterprises on the supply chain in Australia as well. And we're seeing entire industry associations come together to respond collectively on those types of issues, particularly within the agriculture sector, and it's particularly Unilever and Nestle that are forcing that shift and that disclosure from those sectors. So we are starting to see it, but different drivers sitting around it, less so about the investor and more so about the supply chain. Do you have anything to?
In terms of the supply chain, I think it's really interesting because if you look at I've had conversations with extractive industries as well. And their typical response when you say, well, what about the supply chain? Why is that not significant in your report? Is, well, they think...
We're a commodity.
Quite rightly as well, I think our major impacts are elsewhere, not in the supply chain in terms of where we buy our fuel and where our tractors come from. It's actually, we create in-house the biggest problems and impacts. So let's worry about the in-house thing as opposed to the scope 3 upstream stuff. I think that the food sectors that you talked about is also interesting, and for them, I think it's the reverse argument. The biggest opportunity to make a difference for them is in the supply chain in terms of productivity gains and supporting vulnerable farming communities and regional communities. And I think a lot of certainly in Australia, we look at the big supermarkets there. That's where a lot of their flagship programs are at the moment in terms of shared value, collaborative opportunities.
We also did have a situation in Australia 18 months ago, perhaps 2 years, in which we had upstream supply chain issues in that there Four Corners reported on the slaughter of cattle in Indonesia. And so it was Australian cattle getting shipped off and slaughtered in the most inhumane ways. That caused the government to ban all live exports of cattle, which had hundreds of $1 million impact upon that sector. And so I think that sector in particular, the agricultural sector in particular, are concerned about those upstream impacts and issues and factors that they might get caught out in as an industry because of their misuse of their product once it goes out to overseas for manufacture.
I'm just curious on the monitoring and reporting side of things for these sustainability reports. I imagine sometimes it can be challenging for sustainability officers to push some of these initiatives through. And I was wondering if there were any sort of easy metrics that they could grab onto, say they have X or Y sustainability initiative. Are there any quantifiable things that they can bounce back to their board and say, look, we've done this, we believe it's good, and this is how we can show that it's actually improving our stakeholder value proposition? What sort of things are they?
So in terms of metrics, the GRI guidelines provide over 100 different type of metrics that you can lend from. What we encourage is it's actually not necessarily the metrics that you grab onto, but it's the process by which you determine what the most important metrics are to report against. So we take people through what we call a materiality assessment, where they are asked to understand the sustainability context. And that's what our report shows, is that they're not kind of doing that. They're not grabbing onto understanding that, understanding what are the issues impacting upon them as a business, but also understanding their stakeholder views and concerns to establish, okay, well, this is where our biggest area of impact or risk is, and therefore we're going to focus on these issues. And when we focus on these issues, isn't that great? Because GRI provides us with a suite of indicators that we can then report to and then show year-on-year progress. So GRI released the G4 guidelines, so the latest iteration of guidelines last May. So it's been about a year and a half. So we're just starting to see the reports coming through now that are reporting to G4. And that was a big shift in G4. Is prior to that, companies tended to go, what do we already have data on? Let's just report on that. And it was often not the issues that were actually important for them as a business to report against. It's very easy to go, we know how many litres of water we consume, so let's report on that. And you can see that precisely within the banks. You look at some banks, you look at their reports and they're telling you how much electricity they consume and how many reams of paper they consume, and it's like, really? Like, that's as far as you can go? Like, let's think about your investments that the decisions that you're making there and the impacts that they have and the risks that you're exposed to in those investments. So this, the shift in the guidelines and the way in which they've asked companies to focus on that, which really matters, will force a change around how they report and what metrics they choose to use to understand that. So GRI provides that sort of raw data, and it's processes like what Cheese talked about today, the internalising of externalities and the analysis that you do around that. It's things like integrated reporting, which allow you to then shift that and talk about that through the kind of strategy lens, in a sense, allow you to relate it to the value creation opportunities.
Can I just add to that? I think there's also a trend that's taking place. I don't know whether you see this here as well in New Zealand. And it's a move towards a lot more outcome impact type indicators. So if you just play it out in a very simple philanthropic community investment space, today a lot of companies are already experimenting, at least in-house, if not publicizing that in the public arena, the outcomes of investments in community. So moving from how many hours of employee time we've given and how many $1 million we've given, to what's the change in the community in terms of health, so the social indicators on health, crime, education, for example. And those things are borrowing a lot from public policy. If you're public policy, and in most countries, there's often an expectation that you will go through some kind of effectiveness, efficiency review process that talks to the voters and the taxpayer on how efficiently you've used the cash to make change in society. And that's connected partly to the integrated reporting framework as well, which starts to talk about the 6 capitals, social capital being one of them. So if you can't explain not just my intervention in making a difference in that social capital space, but actually start to measure the change itself, then there's a big problem in selling the value story. And just interestingly, we're doing this other project at the moment that's moving from not just how much money I'm giving to analyzing the way I make my decisions, the way I make my design. This is a design organization. What choices do I have in making a product, whether it's a building or a car, that actually has different outcomes from a society perspective, from the use of the product's perspective, or the use of the product leads to increased livability in my community. And if I can explain that and articulate that and in some way quantify that financially, then you're also really adding ammunition to that question about how do I sell it. It's not just good to do, it's actually great for business.
I'm just interested to know about how this is actually, or what you're seeing, whether you've actually investigated how it's playing out in decision making in businesses.
Yeah.
So from the board level through to management and actually day-to-day operational. So I think we all see the theory and understand that, and we've probably had a go at doing materiality, but it's then actually getting that embedded into actual decision making at all those different levels.
We haven't done it yet. It's a really good question that you ask, and it's exactly what I was thinking as Chi was talking there, is that in the past there's kind of been this assumption that a sustainability report, okay, it's done, great, it's out the door, our job is done for the year, we'll wait until 9 months' time before we need to start this process again. And I think there's a real shift happening at the moment where companies are really starting, particularly sustainability teams, are really starting to think about, how do we get more utility out of this? Is this really informing decisions? Whose decisions is it informing? How do we drive change using this as our evidence to create that change internally and have those internal discussions? And I see you're from NZ Post, and thank you for coming today. And when I've spoken to companies about integrated reporting, that's allowing those conversations to be created in a different way to what they have done in the past, because it is focusing you on different aspects and having a broader conversation across the organisation.
Sorry, just wondering whether on your kind of risk treatment profile, you talked a little bit about what resonated with me, and that's that a lot of organisations are very good at articulating what their impact externally is, but not very good at articulating what drivers or what risks may impact on them. Have you looked at that from a from a kind of typifying within sectors? Typifying by sector. And the reason I ask, I guess, is I work a lot with commercial property stakeholders, work with a lot with the listed organisations, and to me, those organisations come from a very risk-averse perspective, and they will always look at, I guess, have an instinct to look at first what the impacts coming in on them are, rather than the impacts going out.
So this slide here, we did it by Megaforce in this slide. In the report, we've done it by industry as well. So you can see it come through there, which industries are focusing on which particular issues. Does that answer your?
Yeah, it does. It's kind of appetite for risk is kind of everything when it comes to addressing a particular business sector.
Yeah.
And a position that they might sit across.
Yeah. We are exploring risk going forward. We haven't. We're just in the founding stages of looking at what we might investigate, but it's definitely a hot topic in Australia at the moment to understand how a company is defining these risks. The management approach seems to be similar to how you'd manage normal risks, but it seems to be the materiality assessment that perhaps is done differently. So within a traditional materiality assessment, you're using a similar kind of approach to what you use to financial materiality. So choosing what's in and what's out, and by broadening the time horizons, broadening the stakeholders that you're considering and their concerns, then you get a broader list of topics that you might focus on, and you start to see the sustainability issues coming in. So it's definitely something that we're interested in exploring further, but it's just a factor of time. We'll get to it. Yeah.
We touched on it a little bit earlier, but to make sort of meaningful change, you've got to get the boards involved at the governance level involved. And unfortunately, unless that's personality driven by someone who's got to really understands this, it doesn't happen voluntarily, generally. And so your conversation with NZX is very important. It's quite early days with the ASX principles, but I'm worried that if we go down that route, that it becomes too risk focused and not broad enough. And just wondering about the context of the conversation with NZX, don't we really need to be going down the South African route or the European route without much broader consideration of this? Because otherwise, know from experience that.
Yeah, I mean, the ASX Corporate Governance Guidelines does use risk within that particular recommendation. However, ASIC, the Australian Securities Investment Commission, also released something in the past year which requires companies to disclose the language that they use is environmental and other sustainability risks, and within the sentence it says risks, but within the chapter it says risks and prospects. So it does force them to think of, I guess, upside risks as well. So there is that playing out simultaneously with the ASX corporate governance guidelines as well. So there is potential that it is that upside stuff too. There is also a lot of traction in Australia around shared value at the moment. And my feeling is that's particularly because it's opportunity focused. It stops everything being a risk, and it allows companies and gives them permission to think about opportunity. And I feel that's why it's got so much traction.
There's also shared risk now. I mean, if you look at the interdependency story, one of the big barriers to actually making that work is corporations tend not to be very good at collaboration, particularly with peers. And whilst there is a lot of case history to show how shared value plays out from the opportunity perspective, there is not a lot on the risk side. And even, if you look at financing structures that are being experimented with today, some of them have to do with how organizations that have a shared risk somewhere in the value chain can come together to fund the mitigation of that one risk. And that's really problematic. But in terms of the earlier question about connection, I think, between materiality and strategy and response for organizationally, it is absolutely a big problem. I think a lot of sustainability reports, not just the reports, but the materiality engine process, those processes aren't normally well connected to strategy. And you think, well, is that just a maturity issue? But it's actually not, because a lot of strategy processes themselves also aren't well connected to fundamental enterprise risk management structures. So if you look at risk management functions and the risk registers that flow from them, how many of them actually reconcile with the short and long-term direction of where the organization wants to go? It's like separate companies stuck in one, and it's really fascinating. Then of course, so we shouldn't hit ourselves too hard by saying, why isn't sustainability material issues? Why aren't they connected so better to strategy? Well, that's because I think generically, functionally, they don't sit well together. They're very different mindsets. Risk averse and being brave, they're just counter to each other.
If I ask, in the interviews that we did, I asked companies, what makes this so sticky for you? How have you been able to continue this, even in spite of changes to your chairman or to your CEO? And they invariably said to me that they've made it so important to the investor that if they were to walk away from it now, the investors would be asking why. You've told us that this is a risk for your business. Why is this no longer a risk for your business? It's still an issue. And so that's what's allowed them to hold on to it and keep it within.
Okay, this is the final question.
I just the role of the media in this in two senses. In New Zealand, they're quite a former of public opinion. I know Australians are far more intelligent than New Zealanders, but in New Zealand, the media is quite a bit. So if you're looking from a company perspective, how you perceive, etc., etc. So the question about the engagement of the media, and then I was fascinated to see on that little circular industry sector thing, each time you showed the media there was a zero something like that, zero score on that. Yeah. And I know the Australian media barons don't boss their journalists around, but I was just interested in the corporate, that coming through, the messages the media put out, and then how important the media is in actually forming the public opinion that cause some businesses to think how the business responds.
Yep. So there's one media company in the ASX top 50, and it's 21st Century Fox. So it's, movie making company, but also, other aspects too. They were by far and away the worst at doing any sort of disclosure in this particular study. This said, media in Australia is quite influential, particularly around talkback radio, and it tends to be held and controlled by just a few companies. So the things that are happening in Australia are very much a reflection of current discourse through the media and through Talkback Radio. Everything from what's happening with asylum seekers through to our emissions trading scheme being removed and those sorts of activities. So yes, they do have quite a bit of influence. What's really been interesting to see, I think, over the past year or so, is that while the emissions trading scheme has been removed and while asylum seekers remains sort of top of front of mind, we've had no boats arrive now for a year or however long it's been. While they're still central ideas, we have seen within corporations climate change teams shrink in a response. But it's almost as though they're going to the social issues as a result, or they're going to biodiversity as a result. And it doesn't mean that everything around sustainability is being deleted and removed. We've seen the ASX make their move on this issue. We've seen ASIC make their move on this issue. So it's just a shift of thinking. It's not a removal of consideration of sustainability entirely as a result of media influence. So that is, in essence, a reflection of a growing understanding of risk, and that these are issues that are going to withstand this particular political cycle. So there has been definitely a shift in the way in which, there's definitely been a shift under the new government of the way in which this plays out in the media. But how that then resonates in business is, it just changes the language around what they're talking about. Do you have anything to add?
No, other than I think the analysis would be very different if, say, we had done this in the UK or on the US. I mean, not only will we have a lot more listed companies, but the spotlight on ethics in the media has been stuck in the last year or two. The News Corp with their bugging and all those stories. So, and if you go back 10 years, the media in the UK has been, they had a lot of social responsibility forums that were created in the early 2000s, led by the BBC, of course, on what's the role of media in sustainability and human rights and things like that.
Okay, thank you very much. I'm going to have to stop it here. I've promised people that we'd wind up by 9:15 because a couple of people have to get away. So I'd just like to thank Victoria and Chi. Really stimulating presentation. Really interesting to hear what the global megatrends are. I'm looking forward to reading the report that's coming out in detail. I think the fact that you're looking at what are the drivers of value against focusing on the megatrends is a great step forward, and I think it's something that we need to have a good think about. And then in terms of how you internalise externalities, I think that's something that's very much on the global agenda at the moment. I think it's just coming more onto the agenda here, and it's something that I know our members are interested in thinking a lot more about. So can you please join me in thanking Chi and Victoria